You're listening to the Master Passive Income Podcast Network. Welcome to the free real estate investing course with me, Dustin Heiner, host of the Master Passive Income Podcast, and I'm going to help you to become a successful real estate investor. In this course, I'm going to be giving you step-by-step how to invest in real estate, and I kid you not, I currently sell this course for $500. It's a video course. Now, there is a couple other things in there, or a lot of other things inside there, but this is the meat of it. I sell this course for $500 on my website, masterpassiveincome.com. Well, because I love podcasting, my Master Passive Income podcast that I've had for, 8 years now, just solo show teaching you how to invest in real estate, I decided I wanted to give this away for free on here because I love podcasting, because you found this. And so you can get all of this if you go to my site and pay $500 right now, or you can go to my site and get the rest of it for free. I'm going to give you my free real estate investing course in PDF so you can download, plus other great goodies if you text the word rental to 33777. Rental to 33777. I'll give you my real estate investing course completely for free with a whole bunch of other bundles of good stuff. If you go to masterpassiveincome.com/free course, going to give you that as well. And I would love it if you get anything out of this, that you would give this a 5-star review on Apple or Spotify and share it with one person, because my goal is to help 1 million people to invest in real estate. Hopefully you are one of them, and then your friends are as well. And let's get into this next lesson. This is titled Why You Should Invest in Rental Properties. There's so many reasons, but here's a few of the reasons that is actually going to change your life dramatically. So here are the 5 ways rental properties make you money. Cash flow from monthly rent. Now, I personally do not buy a property if I don't make money from it. There's no point in buying a property that you don't make money every single month from it, because it's actually going to cost you money in the end. So cash flow from monthly rent is passive income. When you buy your rental properties, you must buy them in such a way that you earn cash flow from day one. Cash flow is money coming in as opposed to money going out. Negative cash flow would be money going out. You don't want that. You want to be able to buy a property and know you're going to make money. And I'm going to show you how you are going to know 100% for a fact if you're going to make money every single month or not. And so with going through this course, you're going to get to know how to do that. The rent minus expenses is your cash flow for the property. Now, if your expenses are higher than your rent, then you're going to be losing money. If your rent is higher than your expenses, then you're going to be making money. It's that simple. Now, obviously, the key is to make sure you account for all those expenses and know where they are and not be taken blindside by that. I'll give you one quick example. One place where I invest in Texas, they have 2 different types of taxes. I went to the county, I looked up the property taxes for the county, and I said, oh, great, $1,300 yearly tax, that's no problem. I put that in my numbers. Didn't know that the city itself has its own stupid tax of $2,000 on top of it. So instead of $1,300 a year coming out of my pocket to pay for taxes, it's $3,300 a year. So that drastically ate into my profits. Now, I bought it well enough to know that if anything did like that did happen, I was still making money. I still own it. I still make about $350 a month from the property. It would have been nice. I would have made a lot more, close to $400, $500 a month in profit, but those stinking taxes kind of got me. Anyways, rents minus your expenses, your cash flow for the property. It's not uncommon to have anywhere from $200 to $300 in monthly cash flow from each property you own. It's as easy as doing the math you learn in elementary school. It's that simple. Income minus expenses is your cash flow for your property. So here's an example. If you buy a rental property that has a monthly rent amount of $1,100 and the total expenses are $800, you profit $300 each month the property is rented. Isn't that amazing? $300, that's going to be coming into your pocket every single month. And so, remember, there are 5 different ways. This is just one of them, but this is a great one. This is how you can quit your job and be actually independent, financially independent, because you have money coming in with you working or not. The next one, equity in the property. Here's another way. So this is number 2, equity in the property. Equity in the property is valued by how much you can sell the property for minus how much you owe on the property. So basically, what it can sell for, just it's basic economics of a product, supply and demand. What somebody would pay for it versus how much you owe on the property. Let's say you're trying to sell a TV. Well, it can sell for $100, but you owe $50 on it. If you sell it for $100, you make $50. That's what equity in a property is like. So market value is $200,000 of an example property. The amount owed that you would potentially owe is $150,000. Now, the equity that you have in the property is $50,000. That's potential selling price of $200,000. You're gonna have that much equity. Now, the reason why this works out really, really well, and I'll give you an example. One of my properties, I bought it for $210,000. The equity came up to where I was able to, after the mortgage payments, went down to where I owed $170,000. Well, I wanted to pull the equity out, refinance it, pull the money out so that I can use that money to invest in more rental properties. Well, I had an appraiser come out, had a bank give me a refinanced note on the property. And so it appraised for $250,000. I originally bought it for $210,000. I only owe $170,000 on it, but it went for $250,000 in the appraisal. So the bank said, hey, you have, what is that, $80,000 in equity. Let me go ahead and give you 80% of the total equity. So I pocketed $45,000 in tax-free money in my pocket to invest in properties. So equity in the property is an absolute fantastic way that the rental properties make you money. Next one. So market appreciation. For the last 200 years, the real estate market has doubled in value every 20 years. Two of the main reasons for this are inflation and interest rates. Inflation causes the price of everything to go up, and lower interest rates raise the price of homes because people can pay more for the homes they normally would. I'll give you an example. Somebody normally has just $1,200 a month to pay for in rent or a mortgage payment. They can't afford anymore. They have their car payment. They have their, child care. They have their insurance. That's all they can afford is $1,200. Well, if the interest rate's 10%, really, really high at 10%, $1,200 doesn't go very far. You could only buy a house that's worth maybe $60,000. But as the interest rates kept going down, now it's 3 to 4%. That $1,200, you can buy a $250,000 house. So your properties that you buy now will appreciate over time. It's an appreciating asset, not a depreciating asset, like your car. Your car is a depreciating asset because it goes down in value every single year. Now, a mobile home is also a depreciating asset because it's not attached to the ground. An appreciating asset would be real estate that is attached to the ground because the value of the land plus the improvements, which would be the house on top of the ground, that is an appreciating asset. And so the government as well as people know that prices of everything goes up. So if your property goes up in value over 10 years, if it goes up $40,000 in 10 years, you just made $40,000 just because of inflation and interest rates, but people would pay more for that property. Next way, forced appreciation. One of my favorite ones. Do things that will increase the value of your home. So your equity is what you already have in the property just as it sits, but you can do things that would actually increase the value of your home. You've seen many of these TV shows where they show you flipping homes and fixing up the kitchens and bathrooms and things like that to make the home worth more. Well, it's absolutely true. If the market value is $200,000, fix up the property to make it $225,000. Here's a big example. So one of my homes, I remodeled the entire kitchen. So the house was worth about $150,000. After I put about $20,000 into the property in remodeling the kitchen, it was worth $220,000. Actually, I think it was like $235,000. So that is a huge gain just by putting $20,000 into the property. It went up, was at $70,000. Fantastic way to make more money and have more equity in the property is by fixing up, making it worth more. Now, the last one is tax deductions. Now, it's a little harder to quantify what the tax deductions would be, but there are fantastic things about tax deductions that the IRS gives you for owning real estate. One, depreciation. Even though it's not a depreciating asset where it's worth less over time, the government looks at it as a depreciating asset. So on your income statement, you can deduct the cost of the house, the amount that you paid for the house over, 27.5 years. You can actually say, I'm taking off every single year a little bit out of my income because of this house that's depreciating, even though, quote unquote, we know it's appreciating. The government says we are going to allow you to depreciate it. Basically, you're making $100,000 a year. You're depreciating all your money from that property in 27.5 years. So instead of making $100,000, they're going to say, well, it looks like you're only making $40,000 because of all these depreciating assets. Now, obviously, talk to your tax accountant. Don't listen to me. I'm not an accountant. I hate accounting. I pay my accountants plenty of money. I love paying them because they do all the work for me. What would take me 8 years to do, they can do it in 20 minutes. So talk to your accountant, but depreciation is something that the IRS and the government allows you to write off the value of your home over 27.5 years. It's fantastic. So we just talked about that. Let's move on. So business write-off. So here's a great thing. A rental property is a business. The IRS sees it as a business. So anything you do for the business, you can write it off. So write off all expenses related to your business as a business expense. Travel, meals, lodging, your technology, cell phones, printers, office equipment, office supplies and equipment, supplies, everything that you're going to buy for your business or do or travel to see, or your gas, all that stuff can go against your actual income as you report it to the IRS in your tax returns. Now, again, talk to your accountant, make sure you get everything written off right. He or she will take care of it well, but you can write it all off. So if you travel to, I'll give you an example. I traveled to Texas for a conference, as well as I checked on my properties. I made sure I did work on my properties. It was a business expense. And so because of that, the whole entire trip can be written off. So I'll give you an example. I recently went to Texas for a conference for my business, as well as visited my rental property. So I checked on them, did work on them, inspected them, did all that stuff. So that was a business trip. But at the same time, it was fun. I had a great time traveling and seeing all Texas and all that sort of stuff. So I'm able to write that off. So your business, your rental property business, you can write off all the expenses that you incur building your business. Also, another great one is 1031 exchange. So you don't have to memorize this, but know that you can defer the capital gains tax indefinitely by rolling the profits into another property that's bigger and better. So I'll give you an example. So let's say you bought a rental property. That rental property you paid $100,000 for, and in 6-7 years it appreciated to $120,000 or $130,000. Let's just round it up to $150,000. It appreciated to $150,000. So you bought it for $100,000, and you can sell it for $150,000. If you did sell it then and just pocket that cash, because it's a rental property business, you would actually get capital gains tax on top of that. So that $50,000 in profit, you would actually have to pay Uncle Sam, pay the government. I believe it's 35%, but it changes. Again, talk to your tax consultant, but you're going to get taxed on it. So imagine just 35% of that $50,000 literally be taken away by the government, your hard work taken away. Now, here's the great thing. The 1031 exchange, you can take that $50,000 positive, not pay taxes on that, roll that into another home that's bigger and better that you can buy and rent out and make more money, and you don't pay taxes. So instead of having that 35%, so what does that come out to? That comes out to close to $20,000 that's going to be taken out of your pocket if you sell the home, given to the government. Take that $20,000 on top of the extra $30,000 that you're selling it because you made a profit of $50,000. I'll try to help you understand. So you have $50,000 profit. Government will take out $20,000. You'll keep $35,000. Instead of that, keep all $50,000 and buy another house that's bigger and better that you can make even more money. And then from there, buy apartment complexes, then buy big skyscrapers. Just keep moving up. You never have to pay taxes until you literally sell the property and take all the profits. That's when you pay the taxes. Now, here are 3 ways you can increase the equity on your property. Now, here's a statement I want you to remember. Remember, you make money when you buy the property. You realize the money when you sell it. Now, here's what I'm explaining, or here's what I mean by that, is if you buy a house for $120,000, but it's only worth $100,000, you've lost money. You didn't make any money in that sale, or that purchase and sale. Now, if it's flipped, if you bought the home for $100,000 and you sell it at $120,000, well, that work that you did to get it lower at $100,000, you made money. So remember, it's not when you sell, because that's when you realize the profits. You realize it going into your pocket, but you make the money when you actually buy the property. So let's look at the first of three ways: reduction of debt. With the monthly rent you collect each month, part of the money goes to pay for the mortgage you took for the purchase of the property. So if you bought a house for $150,000, you put a tenant in there, that rent coming in, you need to make sure that that rent is actually going to be able to cover all the expenses, and that includes the mortgage payment. Now that tenant making that payment, you may then make that payment to the mortgage company, and that decreases the total dollar amount that you owe on the property. So your tenant pays down your mortgage for you. Isn't that fantastic? So a $100,000 home, which can be rented for $1,200 per month with a 4% interest rate, 30-year mortgage is only $477 per month. So if you actually worked it all out, you'd be paying $477 a month in mortgage payments to the bank. But look at how much you're renting it for, $1,200. You're making a ton of money. Each month, the principal balance of the home is paid down by the tenant. It's not you. So you basically, even though you paid or you got the mortgage for $150,000, you're not the one actually paying for the property. Your tenants are paying for the property. It's fantastic. So another way, make money on the first day you own the property. So right when you buy the property, right when you own it, you make money when you buy your rental property because, like stocks, you buy low and you sell high. Your goal is to never lose money, and you can only do that if you buy a house that fits our criteria, which I'm going to share with you in a little bit, that will make you money when you buy it. You always want to make money when you buy. You don't want to lose money when you buy. Just like I say, you never want to have negative cash flow. You always want to have positive cash flow. So let's say you find a deal on a property that is worth $150,000. But you can buy it for $100,000. Well, that is $50,000 in equity that is kept in your investment. When you want to cash out the property and actually cash out the $50,000, you could either refinance the property, which I've done, like I explained in the last video, and get a note for the equity, or sell the property and pocket the difference. So you make money the first day you own the property, because you buy it right. If I would say, don't buy a property that you're overpaying and you're paying more than what it's worth. Next, forced appreciation through rehab. We just talked about this recently just a little bit, but you can increase the value of the same property you just bought for $100,000 by rehabbing it. You can remodel the kitchen, the bathrooms, add fresh paint, install new flooring, fix up the front yard and backyard, do landscaping, add another room. All these different things can actually make the value of the home more. The property that had a market value of $150,000 may now be worth $200,000, even though you only spent $20,000 to fix up the property. Wouldn't that be amazing to actually pocket $30,000, spending $20,000 and pocketing $30,000 in equity? It's fantastic. So basically, you can make the property more attractive to future buyers by fixing it up, and then makes the value of the property increase. I'm going to give you some quick non-monetary reasons to own your properties. And remember, monetary would be, money, putting money in your pocket and all that sort of stuff. So here are some really great reasons to own real estate. Complete control over your assets. Unlike a stock, which you don't have control over, only control is buy or sell. With your rental properties, you can control every bit of that property. No liability, but all control. And I'll show you how, because we'll start LLCs, a limited liability company that will control the that will own the property, but you control the LLC. So you control the property, but you don't own it, so you don't have any liability. The company has a liability, so they can't come after you. We'll learn all of that in a little bit. Next, making money in an up or down or sideways market. I want to tell you, I've made money. Like I said, in 2007, when this market was crashing, I actually made money, and I still make money because of those properties that I bought. If you buy it right, you can always make money. You can use leverage with other people's money, OPM, other people's money. You can borrow from your mom and your grandma. You can borrow from the bank. You can borrow from an investor. Basically, you're using other people's money, just like getting a mortgage, to buy a property, and that property makes you money every single month. So you don't have to use your own money. You could even get something like seller financing. Somebody who owns a home that wants to sell it, but they don't need the money, so they're going to have you allow you to pay it over month to month, just like they're the bank for you. Another one, a hedge against inflation. If you buy the property at $100,000, inflation is going to automatically go up. Well, your property is going to be worth more and more every single year. It's always going to keep going up. There might be some downsides or downtimes when the market goes down, but it's going to always go back up. So it's a hedge against inflation. You could also insure your investment. Imagine going to just like with other people's money, insuring your investment. Imagine going to a banker and saying, "Hey, banker, can I borrow $100,000. I want to buy this brand new company stock. It's just coming out. It's an IPO. I want to buy it because I think I'm going to make a lot of money." The banker is going to laugh at you. He's going to say, "There's no way I'm giving you money for that. That's ridiculous." Now, if you say, "Hey, I want $100,000 to buy a house," he'll say, "Sure, sign right here." Same thing. You can't insure your stocks. They say that you can with options and things like that, which is possibly true, but you can't go out and get car insurance or homeowners insurance on your stocks and actually ensure that you're not going to lose money. With a rental property, you absolutely can insure your property just like you would get normal homeowners insurance. Insure against fire, theft, loss, wind damage, rain, hurricane, all that sort of stuff. So you can insure your investment. Also, wealth preservation. This is something that you're going to be able to pass on to your children and your grandchildren, and then so on and so on. It can be passed down from generation to generation, so you can preserve your wealth. And this would be, if you do it right and talk to your accountant, it can be tax-free as well. Also, you can leave a legacy, like we said, with wealth preservation. You're going to leave a legacy that's, hey, my dad, my grandpa, my great-grandfather thought enough of us to leave us properties so that we will be set up for success. Now, let's look at find the value of the deal. So how to make 780% return on your money. This is exciting because imagine making 780% return on your money in 1 year from the money that you put into a property. Imagine doing that in the stock market. Everybody would be jumping on that. But this is a real estate rental property that actually can make you 780%. So let's look at an example of how it could actually work out. So let me quickly show you the net profit valuation. So step one, calculate gross, and we'll go through it in just a second. Calculate gross rents both yearly and monthly. Step two, add up in total all variable expenses yearly and monthly. So rents or income yearly and monthly, expenses yearly and monthly. Step 3 and 4, add up a total yearly mortgage payments and deduct variable expenses and mortgage payments from your gross rents. Easy. Income minus expenses, including your mortgage. Income minus expenses. And step 5, take your net figure, so whatever is left out, and divide it by your down payment. So how much you paid to get this investment. Your down payment for the stock would be the same thing, like what you actually paid for the stock. This will give you a percentage figure that will give you a rate of return on your invested cash. And here are some examples. So if you put $2,000 down on a property and you make $500 a year, your your return on investment is 25%. So 25% of what you actually invested in the investment, that would be 25%. So if you bought a stock for $2,000 and 1 year it made you $500, you made a 25% return on your investment. Same thing with rental properties. It can be the same thing. So I'll give you an example. If you put down $2,000 but made $4,000 in 1 year, your return is 200%. Here's another example. So let's say you put that same $2,000 down and in 1 year returned $5,000 in your pocket of cash. That would make you 250% return on your investment. Wouldn't that be amazing if you can get a stock that can give you could pay $2,000 and it gives you $5,000 in return on top of your $2,000 you initially invested? That would be amazing. Everybody would jump on that. Now this ends day number 2, and I'm so glad you guys have made it this far. There was a lot of information to take in. Okay, so next up is day number 3 in this real estate investing course, and it's how to think like a rich person. So what we're going to focus on is changing our mentality and our attitudes and our understanding about money so that we can actually become rich. Because if we keep thinking like a poor person, we will stay poor. And that is it for this one. Remember, get my real estate investing course completely for free. Text the word rental to 33777 or go to masterpassiveincome.com/free course. And if you got anything out of this, I would appreciate it if you went to Apple or Spotify or wherever you're listening and give it a 5-star review. So hopefully more people will be able to learn how to invest in real estate and change their life. All right. We'll see you guys in the next one.